Here is a number that should make you sit up. Saudi Arabia has been reported to commit around $12.5 billion to putting real-world assets onto blockchains, and as of today, Thursday the 6th of August 2026, the world's largest stablecoin issuer has planted its flag there. Tether confirmed early this afternoon that its Hadron platform is working with the Saudi company First Data and the payments infrastructure group BKN301 to tokenize institutional real estate. Tokenization, in plain words, means taking a physical asset like an office block and issuing digital shares in it that settle in seconds rather than months. The significance is not the technology. It is who signed, and where. This did not appear from nowhere. Back in April 2026, Tether put $8 million into Kaio, a strategic bet on real-world asset infrastructure, and today's Saudi deal is that thesis being cashed in. Tether earns enormous income from the reserves backing its dollar token, and tokenization is how it turns that cash pile into a business that is not purely dependent on interest rates. The competitive pressure is real too. Ripple has been investing in ZILO and Licuido to build regulated tokenized issuance and collateral movement on the XRP Ledger. Whoever controls the rails controls the fees. Saudi Arabia matters because Vision 2030 gives state backing to exactly this kind of experiment, which removes the regulatory guesswork that has stalled tokenization elsewhere. So what changes on the ground? Saudi property grew a modest 2.6% year-on-year in the second quarter, and that softness is precisely the opening. Tokenization lets a developer sell fractions of a building to unlock cash without waiting for a full sale, and it lets smaller investors buy exposure they could never afford outright. BKN301's role is the unglamorous but essential part, moving money between the digital token and the ordinary banking system. For now, this is institutional only, so retail buyers in Britain will not be purchasing a slice of a Riyadh tower this week. The nearer-term effect is on sentiment, giving stablecoin issuers a credible use case beyond trading speculation. Be careful about the hype, though. Analysts covering today's news flagged regulatory uncertainty as the main break, and they are right. A token proves you hold a digital claim. It does not automatically prove a Saudi court will enforce your ownership of the bricks. Watch 3 things over the coming months. First, whether an actual property is issued rather than just announced. Second, whether a secondary market appears where those tokens genuinely trade. Third, whether custody arrangements satisfy institutional auditors. The macro backdrop helps, with ICA forecasting a Gulf rebound of around 8.1% in 2027 after a conflict-driven contraction. Capital returning to the region needs somewhere to go, and this is being built to catch it. Here is the thing to remember. Today's announcement is not really about property. It is about Tether shifting from being a dollar token issuer into being financial plumbing for entire economies, and choosing a state with political will to do it. If the first Saudi building actually settles on chain and trades cleanly, tokenization stops being a conference talking point and becomes ordinary market infrastructure. If it stalls in legal ambiguity, it joins a long list of promising pilots. Judge it by transactions, not press releases.